Okay, so let's start with chapter 19. All right, so we have 6 objectives that we're going to go over. First one, we'll identify how changes in volume affect costs. We'll learn what CVP analysis is and how to use this analysis to compute break-even points. Then we'll use CVP analysis. CVP is cost, volume, profit, right? For profit planning and graph that CVP relationship. And then we'll use this method to perform sensitivity analysis. So today, hopefully, we'll do first 2. All right, well, with the delay, I'm not sure, but we'll try. Fifth one, we'll calculate the break-even point for multiple products and services, and then we'll distinguish between variable cost and the absorption costing. Okay? So pay attention, this is something that's discussed also in my accounting lab. Okay? All right, so let's start with the first one. We want to identify how changes in volume affect our costs. Okay. So some costs, just like your cost of goods sold, they increase as the volume of production also increases, right? And some costs do not. So what we want to figure out here is which costs are affected by the increase in volume and which are not, and how do we deal with them? Okay, so why do we need to know this? Why do we want to distinguish which costs are affected or not? Because all your managers, they want to know how business are going to be affected once the production line is added or you have a reduction maybe in production and so on. Okay, so variable costs. Is one of the portions of our cost. We've talked about them. What is variable cost? Why is it called variable? Because the cost changes, right? And that change depends on your production volume. So it decreases or increases in total in direct proportion to changes in volume of activity. What does it mean, direct proportion? It means that once your volume of activity goes up, right? Then your costs are also going to go up. The variable costs are going to go up. And when it goes down, the variable costs are also going to go down. Fixed costs. Fixed costs is also a part of our cost, and it does not change. So what would be a good example to illustrate what is a fixed cost that does not change depending on the volume of production? Rent, right? So here is a little note. It's true for rent if I'm still using the same building, right? So if my production is increasing and I'm still utilizing the same amenity, then yeah, my cost is not. But what if I'm increasing so much that I need to rent another one? Then my fixed cost is going to change. So remember this. We'll talk about when there is a relevant, let's say, relevant range, okay, when fixed cost does not change with volume, right? So keep that in mind, yeah.
Does labor change with volume also?
Might not, right? Because if my labor is a supervisor who is just walking around that facility and monitoring all different lines of production, it's one story, right? And if it's one person and I need to add the number of people who are maintaining another line within that building, then yeah, it's going to go up, right? So labor is different as well. Okay, and then we have these mixed costs. So mixed costs are those that have a portion of variable and a portion of fixed. So let's look next. Okay, so we have we just figured out that our variable costs are going to change with the change in volume of production or activity. Okay, let's call it activity, whatever that is. So also can include the production, but it's not limited to this. So if activity goes up, then the cost goes up, right? Now what about, so I'm producing 100 of tables, right? And now I started producing 150. What about my cost per one table? It's still the same, right? So all the variable costs are changing with the activity, okay? Per unit, it does not change. Okay, we'll illustrate this. So if my cost, my variable cost for that production of a table was $100, it does not matter how many I produce, right? That's per unit. Okay, so next one, how can we measure our volume? It's units sold, units produced, miles driven, phone calls placed, etc. Okay? All right, so let's look at the illustration. So we have this table and a graph, and they both illustrate the total variable costs. So let's look. On the very top, right, we have number of events. Let's say this is a company who is, I don't know, performing songs or something like that. So number of events that we had per month is 15, okay? I'm trying to plot my variable costs. I know that to rent my equipment, each event I have to pay $15. So by multiplying these two numbers, I'm going to have that my total equipment cost is $225. Okay? Now let's look at the next one. When I have 20 events per month, it still costs me $15, right? So my cost per unit is not changing. My total cost, my total variable cost is changing, right? So when I'm multiplying 20 by 15, I get total cost per unit, per month, and it's 300. Okay, so it's going up. Now let's look at 30. When I have 30 events, it's still going to cost me $15, but my total cost for the equipment is going to be $450. So let's try to plot. Now look at this corner where I have zeros. What does it mean? It means that when I do not have any events, I don't pay anything for equipment, right? This is your origin. Okay? And then let's plot this 15 events at $225 a month, right? So I'm going to take 15 events and go and find my 225, and that's the intersection, right? I'm going to do the same thing for the other numbers. Okay, so here is the line that represents my total variable costs. Do you see how it's going up? Once my number of events are increasing, my cost is also going up. Okay, and it's a straight line. So the relationship is a straight line, right? Okay. All right, so let's look at our fixed costs. Now, fixed costs, we just said, they're going to be different from variable costs because they do not change with volume, right? Why they do not change? Because it's a cost for renting that building, right? That factory or the office space. So my fixed costs tend to remain the same, right? The same amount. And it doesn't really depend on the level of activity. Now, what could be examples? My salaries, right? My part-time manager salary is a good example. Okay. So fixed costs, total fixed costs do not change, but the total fixed cost per event changes, right? It depends on number of events. So do you see how it's another way around when we're talking about the fixed cost? So the more activity we have, the less the fixed cost per unit. All right? So let's look at the picture. Okay, so looking at the table, I have total fixed cost, I have number of events, and then I have fixed cost per event. Look at this. If to me the fixed cost is $12,000 and I only have 15 events that month, my fixed cost is $800. But if I have 20 events, it's $600. And further on, if I have 30, it's only $400. So the more events I have, the less is my cost per event, fixed cost per event. All right, so let's try to plot this. So we said that, do you see how independently of the number of events, my cost is still the same? So what I'm going to do, at 12,000, I'm going to find where I have 15 events, and then 20 events, and 30. And my line is going to be parallel to the number of events axis. Okay? Yeah? Say again, am I going to do what? Well, yes, so here what you do. To find your total fixed cost, you're going to take your number of events and your fixed cost per event. Or total fixed cost, you're going to divide by number of events. And that's how you're going to find your event cost per, fixed cost per event.
Or unit, right?
Yes, we'll do these computations in a minute. All right. So we know fixed costs. We know what variable costs are. What are mixed costs? Mixed costs have both components. Some of it is fixed, some of it is variable. And you don't really know when you look at the number which portion is which, okay? So you can't really split just by looking at it and say. So how we identify what is the percentage of that mixed cost is a fixed and which one is variable, we need to know how to calculate that. So let's see how we do that. An example of mixed cost would be your cell phone. Okay, so some of the plans are going to say, I'm going to charge you each month $50, and then on top of it, and that $50 is going to include 100 minutes. On top of it, each minute that you go over is going to cost you, let's say, 50 cents. Okay? So if you had 101 minutes, you're going to pay $50 that you have to pay for 100, and then for 1 minute you're going to pay 50 cents. Okay? So your $50 is going to be a fixed cost, and that 50 cents per each minute is your variable. Okay? Variable cost. So just like your utilities. Okay? So you're going to pay some fixed cost, whatever that is, and then they're going to read your meter and say, oh, okay, so that's on top of that. It's never going down. It's only on top. All right, so let's look at the illustration. So let's say I had a decrease in the cell phone charge. I told you $50. Let's say it's a $10, cheaper than that. Okay, so this is your fixed cost, okay? And it does not really matter how many minutes you're going to talk for that fixed portion of a cost. Now, where it does matter is once you used your minutes, you're going to acquire some additional cost, okay? And this variable cost is going to increase your mixed cost, your total bill that you're getting. Okay? So just like I said, it's good if you have this picture, but what if you don't? and you just have a number. So let's say you're paying $40 and you do not know what is it you're paying for. Okay? So you need to figure out how to identify where is your fixed cost and where is your low cost, variable cost. So we have a couple methods that we'll use. First one is the high-low method. So a high-low method kind of speaks for itself. So what I'm going to do, I'm going to take some number that's going to be the highest and some number that's going to be the lowest, and then do some computations and get a fixed and a variable cost. So let's look in details. This method allows us to distinguish which cost is which, but also it's not as precise as, let's say, your regression. Okay, in cost analysis, in cost accounting, you would do much more complex and difficult computations. Okay, this is something to approximate the cost. Okay, so what is it? We're going to identify which is our highest activity and which one is the lowest activity, level of activity. Then we'll calculate the variable cost per unit. Then we'll calculate our total fixed cost, right? Variable, then fixed. And then we'll use the equation to show which one is a component of a mixed cost. So how do we calculate the variable cost? It's change in total cost divided by change in activity volume. And then the total fixed is mixed minus variable. And then we have the very long one for the components. Let's go over each one of them. So let's say we have this data. Okay, we have event plane hours for different quarters of the year, and then we have total maintenance costs that we had to pay for those quarters. So what are we going to do first? We said that we're going to first identify which one is highest and which one is lowest level of event, right? So we see here 1960 is the highest volume, and then 1480 is the lowest volume. So we're just going to play with those two numbers for now. So let's do the first step. We're going to calculate the variable cost per unit. So my variable cost per unit is a change in cost divided by the change in activity. Okay, you take your cost and you divide it by the change in activity. So let's look. What did they do? They took the highest number, subtracted the lowest, right? So we got this difference in the highest and lowest, which is $480 here. And then we're going to do the exact same thing for our hours. So we're going to take 480 and we'll subtract 240. So what did we get? We got $480 divided by 240 hours. So my change in my highest level of activity and the lowest level of activity expressed in dollars and hours, and I divide them. Okay? So I get that my variable cost per unit is $2 per event plane hour. Okay, so we need to do second step. What was the second step? We need to calculate the fixed cost, right? We have the variable. Let's look at the fixed. Now, am I going to calculate fixed per unit or not? What am I calculating? What is this next step? It's total cost, total fixed cost. So when you're calculating, don't get mixed. I'm calculating my variable cost per unit, but the next calculation I do is my total fixed cost. Okay? These two are usually, you get messed up right here usually. Okay? So here's what we're going to do. My total fixed cost is my total mixed cost minus my total variable cost. Okay? Mixed cost less variable cost. Because the component of mixed cost is a fixed and the variable, right? So mathematically, your fixed cost is a mixed minus variable. Okay? So what am I going to do here? I'm going to take the $2 per event plane hour, and I'll multiply it by 480, right? By my highest volume, because I'm looking for variable cost. For the mixed cost, I'm going to take my highest, this 1960. Okay, so I'm going to use just one number out of the column, out of the table. So I pick third quarter, the highest. Now, can I do the same for the first quarter, or the second, or the third, or whatever that is? Can I use other rows? I can do that. So let's finish this. I took the highest volume, right, and I said, okay, my mixed, I know that my mixed is 1960, right? That's given to me. And I know that I pay $2 per event plane hour. So I'm going to take $2 and multiply by the event plane hours. And I got 1,960, and I subtract 960, and I get 1,000. So if you do that for do that for the other one. Let's look at the other one. Let's do for the second one. So I have 1830 as my mixed cost, right? So my mixed cost is 1830, and now my variable cost is what? I'm going to take my $2 per event plane hour and multiply it by, anyone is awake? 415, right? So I'm just going to use this row. Okay, so what do you get? You get 1,830 here, and then 2 multiplied by 415. So 830 here. 1,830 here minus 830 here. I again got 1,000. Okay, so it does not matter which row you're using. Okay, so let's look. Our third step. All right, here we're gonna let's calculate. Actually, let's first figure out how do we calculate the mix of this mixed costs. So what do we have? We have total mixed cost, and we have total equipment maintenance cost. We just figured the total equipment maintenance cost, right? Which was kind of here. We're just rearranging the numbers. So let's see. We have $2, right? We know our $1,000 where it's coming from. So let's see here. That's our 1,000 fixed cost, right? So I'm going to say that I'm using my 400 event plane hours, and I know that $1,800 is what I'm going to have to pay. Okay, so let's look. We have highest volume, lowest volume, right? We just used it to calculate $2, and we know how much is our fixed cost is right now, right? So the mix is my $2 by 400 event plane hours. That's what I registered for this month, right? That's what I sold for the month. And then I have $1,000 of the fixed cost. So my $1,800 is what it's going to cost me altogether. So let's see if it makes sense with the original data. Right? Does a cost of $1,800 would make sense, or would it not make sense? What do you think? If I just analyze the numbers, it should make sense, because it's definitely lower than my highest volume, right, which is 1960 for the 480 hours, but then it's also right below the second quarter, which is 415, and that was 1,830. So looks like it makes sense, right? So that's how you would be calculating this. So what did I do with the 3 steps? I found with my high-low method how to separate the cost, right? All right, so let's see. You remember how we just discussed that sometimes not all costs are relevant, and we need to understand when the fixed cost or the variable cost is within the relevant range. So the relevant range is letting you know that if my production, right, let's say volume in hours per year, if my production is between 10,000 and 20,000, I'm within my relevant range, and my costs are what I calculated, okay, or what I know. So do you see how within from 0 to 10,000 volume in hours per year, my fixed cost is only going to be 72,000, right? But once I'm going to bump it up from 10,000 to 20,000, my cost goes up as well. Okay, so once you calculate the variable costs and the fixed costs, it's not necessarily applying to every volume of production or of activity. You have to know the relevant range. All right? Okay. What would be an example for relevant range? What's a good example? When would I need to know the relevant range? When would it apply? It especially applies when I have to rent out another, let's say, facility, right? It's a big cost. And if I'm expanding my business to the point where I need another facility involved, my relevant range changes, right? Because if I'm using one facility to produce 100 units, and I need another facility because I'm planning to produce 150, my fixed cost has just changed once I started producing from 101 unit to, let's say, to 100. My fixed cost is going to go up because I have to rent another facility. All right? Okay, so let's look at the example. I'm going to go over this with you. So I have this Philadelphia Acoustics that builds very interesting and nice speakers, okay, for music, home theater systems. So let's consider those costs that are listed below, and let's say which ones are variable, which ones are fixed, and which ones are mixed. So units of production depreciation on routers used to cut wood enclosures. Unit of production depreciation on a tool, let's just say. Why is it fixed? Why do you think it's a straight line depreciation? It's units of production depreciation on, yeah? It's variable, right? Okay, wood for speaker enclosures. Fixed? Why fixed? But it's a different story, right? We said that per unit and the total cost is different, right? So let's see. Patents on crossover relays. fixed. Why fixed? Does not matter what is the quantity. Total compensation to salesperson who receives a salary plus a commission based on meeting sales goals. Mixed. Cool. Crossover relays. Part. Just a part. Part of the speaker. Am I right? I'm pretty sure it is. That's what a relay is. It's a variable, right? It depends on how many I'm producing. Okay. Straight line depreciation manufacturing plant. Yes, that's the one. Okay. Grill cloth. That material that goes. What is it? Fixed or variable? Variable? Okay, cell phone costs of salesperson. Plan includes 1,200 minutes. Overseas calls are charged at an average of 15 cents per minute. We just talked about the mixed cost for, that's a good example of a mixed cost, right? What about glue? Variable. Quality inspector's salary. Very good. Okay, because you were so good, we have another one. Okay, so we're going to do a couple parts of this problem. And ask me questions if you do not understand how we calculate this. So Martin owns a machine shop. And in reviewing his utility bill, we just talked about the utility, right? So it's all mixed costs. For the last 12 months, he found that the highest bill was 2,800, and it was in August. Okay, at that time, his machine worked 1,400 machine hours. His lowest bill was 2,600, and it was in December. And at that time, machine worked 900 hours. So what we need to calculate right now is first, variable rate per machine hour, and second, Martin's total fixed utility cost. Okay, so how do we calculate the variable cost? The variable cost per unit is our change in total cost divided by change in the volume of activity. So total cost divided, change in total cost divided by the change in volume. So what are we going to do? We're going to take 2,800, subtract 2,600, and all of that divide by the difference of 500, right? 1,400 minus 900. So what are we getting here? It's 200 divided by 500. So what we found is 40 cents per machine hour. That's my variable cost per unit. Okay? So what I did, I took the highest amount that I paid, I subtracted the lowest amount that I paid, and then that difference I divided by difference of the volume from the highest to the lowest, yeah? Okay, good. Now we need to find our total fixed cost. So my total fixed cost is the mixed cost minus variable cost. Okay? So how do I know my mixed cost? What am I going to do right now? Do you remember how we had the table and it had different rows for first, second, third, and fourth quarter? And I said that to find your total fixed cost, you can use either. So in this case, I can either use my highest bill information or the lowest, and it's still going to be the same. Okay, so let's use the highest. Okay, so my mixed cost I know is 2,800, and my variable cost is what? How do I find my variable cost?
2,800 minus 1.9 times 1,400.
Yes, very good. So I'm going to use the machine hours for the highest bill, and I'll multiply it by this 40 cents per machine hour that I just found. Okay, let's look. I gave you too much. Okay, so total fixed cost is the difference, and that's how we find the total fixed cost in this case. It's 22,240. All right? Does it make sense? Not difficult, right? Wait for the exam. All right. Let's look next. This one is trickier. What we need to figure out is what is the equation to determine the total utility cost. Okay? So how do we calculate the total cost? What are the components of the total cost? It's the variable cost plus your fixed cost, right? So we just said that to calculate the fixed cost, we know it's 40 cents per machine hour. And we also know our fixed cost right now, right? Did we? Yes. We have the fixed cost, we have the variable cost per unit. So somehow we need to put these numbers together and get the total cost. Okay? So here's what it's going to be. I'm going to take 40 cents. I'll multiply it by machine hour, whatever is known to me. This per machine hour, I'd rather just do multiplication. Okay? So it's 40 cents multiplied by a number of hours plus the fixed cost of $2,240. Makes sense? Okay, that's not it. There's another part. Here you go. So if Martin's anticipates using 1,200 machine hours in January, we want to figure out what is the total utility bill using the equation from the very first slide. So how am I going to calculate my total utility bill? What am I going to do? It's going to have two components. One is a fixed cost. The other one is a variable cost, right? My utility bill is a mixed cost. So what is a fixed cost? Wake up. It's $2,240, right? How do I calculate my variable?
You do 140 times 1,200 and you add it to the 2,240.
Very good. Yeah? So I took my 40 cents, multiplied by machine hours, and then I added the fixed cost. All right. Done? What? It's given. Anticipates using 1,200, right? Is the sign-in sheet going through the room? Everyone sign it? Cool. Thank you. All right. So the other one, we looked at some graphs, right? We know how the fixed cost, what the fixed cost is. We know what the variable cost is like. And we looked at the example of the mixed one. Now let's look at this particular case. So let me explain to you what's happening here. Although it's not all colored, if you look right where the mixed cost intercepts with the cost axis is where I can determine my fixed cost. How can I do that? Right at the 0, think of it this way. No matter how much I produce, I have to pay this. Okay, so this is my fixed cost. It doesn't matter. Even if I produce a 0, it's still the same. Now, further on, this graph is what? That's your mixed cost. This portion of the graph is your variable cost. Okay, so this is your variable. This is your fixed. All right. Okay, let's go through the second one. We're not going to finish it, but let's do some of it. So CVP analysis, this is something new. We're going to use all of what we've just done in the CVP analysis. So if you have any questions, you know where I am. Okay. So what is the CVP and what is it? CVP stands for cost, volume, profit. So you're going to do some analysis to figure out what are these three components. What is the cost, what is the volume, and what is the profit? So the analysis expresses some relationship, right? And profit is not always profit. It can be loss. So what are we trying to do? This analysis is trying to answer the following questions. How many products or services must the company sell to break even? New definition for us, right? Break even. We'll see what it is. And what will profit be if sales? How do I estimate my profits if my sales are expected to double, right? How will changes in selling price or variable cost or fixed cost affect my profit? Okay, so the following assumptions are something that you just need to keep in mind. This is true for CVP analysis. So managers classify costs as either variable or fixed, done by managers, okay? And then the only factor that affects the total costs is the change in volume, okay? That's it, just like we discussed in the first portion. And the fixed costs, they do not change. We know that. Okay, so remember the following, that CVP is only an approximation. It's not exact. It's just an approximation. Okay, so I just said something with the break-even point. What is the break-even point? So break-even point is where my sales level are at such number where the operating income is 0. What does it mean for me? That my total revenue is the same as total cost. Same number. It's equal. Okay? What does it mean break even? I need to do just at least that much, so that I do not incur any losses. I don't have really any profit, but that's my break even. So think of it just in this way. Not very scientific, but think of it this way. So my sales are above break-even point are going to be my profits. Whatever is below is my loss. Okay? That's why it's called break-even. My revenue is equal to the cost. Okay, so we have couple methods. The contribution margin approach is going to have another one, kind of like a derivation of this, but just think that there are two main ones. One is an income statement approach, and the other one is a contribution margin approach. So my income statement is just as if you were looking at an income statement. It has sales revenue, total cost, operating income. Very simple calculations, okay? My operating income is equal to the difference between the sales revenue and the total cost. That's it. Now the contribution margin requires a little bit more of a calculation, but it's not that difficult. So I'm going to find what am I going to look at it. I'm going to see my operating income is sales revenue minus variable cost, but there is also this contribution margin and fixed cost. Okay, so let's look at each one of them. Here, so this is my, look at this, operating income is 0. This is a good illustration of a break-even point. Why my operating income is 0? I'm trying to do, what I'm trying to see here is what is my income statement approach to figure out what is a break-even point, okay? So keep in mind, when we're talking about break-even point, your operating income is a 0, okay? So let's look at this. What do I have? I have, we just figured out the equations, right? So my sales revenue minus total cost is my operating income. Now my total cost, we know, have two components, variable and the fixed. So now my operating income becomes sales revenue minus variable cost minus fixed cost, still operating income, okay? So let's look in details. What are we doing here? So sales revenue is your sale price per unit multiplied by the units sold. We're just going to split the formula more and more, okay? My variable cost is the variable cost per unit multiplied by the units sold. Makes sense, right? Then we have our fixed cost and the operating income. Now we need to put all of this in numbers. In the very beginning I said that keep in mind when we're trying to calculate the break-even point, operating income is always 0. So I'm going to put this 0 right away. Now let's look. I know my sales price per unit. It's the continuation of the same problem, right? We're still talking about the events, okay, from the first part. So do you remember we figured that out, that the sales price for that event was $200. We need to know how many units we need to sell to break even, right? So we're just going to leave it as a unit sold. We'll label it like that. The next part is the variable cost. Do you remember we calculated the variable cost was $80, okay? And then again, we need to know how many units we need to sell so that we break even. So we're going to leave it just as units sold. And then the fixed cost we know is $12,000, and operating income is always 0 when we're calculating the break-even. So what am I going to do right now? Out of these two, I'm going to move my units sold out of the brackets. Now I have 200 minus 80, and then multiplied by units sold. Does this make sense? Minus 12,000, my fixed cost. My operating income is still 0. Now I'm going to try to rearrange all of that to figure out how many units do I need to sell to break even. So I have 120 multiplied by units sold, and I'll move this 12,000 to the right. Now my units sold is 12,000 divided by 120. So I know that at least to break even, I need at least 100 events booked. Does this make sense? Sinking in? Okay. So let's look at the next one. Any questions on the previous? Yes.
So is overhead a variable cost?
Just like we said right now, the reason why I said that for CVP there are certain assumptions because your managers are going to define. Although we may act as managers, right, and we can assign. So in your case, you're asking overhead?
I'm wondering if there's any correlation between direct
Example.
and overhead costs. So direct labor a variable cost, or is direct labor a fixed cost?
So if your direct labor is the one that's standing at the machine and pressing a button, and it depends on how many units of, like if you have to add another line of production and you're going to increase the production, and therefore you'll need to add people, right, that are going to be pressing that button. That's going to be what? That's going to be your variable cost, right? With the volume, you're going to have more people working. Okay? So that's your direct. And then you said direct labor, and what was the second one?
If that had any correlation.
With what?
Maybe overhead also.
So we had an example with overhead. We had an example of a renting a plant or some facility, whatever, an office. Okay. So if I have to expand my business and hire more people to be at that office, but the office has only a capacity of 30 people and I'm at 50, I have to rent another office for the other 20. Right. So although it's a fixed cost, if it's out of that range, right? Yeah, then I have to treat. If I'm just treating it within that range, then it's relevant to the fixed cost, right? I'm going to compute it as just that. So it really depends what the manager is using. We talked about the relevant range, and I think that's what you're asking about. Okay? So let's look at the contribution margin approach. All right, so as you see, it has very similar components on this big formula. The contribution margin is really a shortcut method, okay? It's not as precise. It's a shortcut, right? It's called contribution margin only because there is the excess of sales revenue over some variable cost that we acquire, okay? And that contributes to covering fixed costs, all right? So let's see how we calculate it so that we understand what does it mean there is a contribution to cover the fixed costs. So we're going to take sales revenue, we'll subtract the variable cost, and that's going to be my contribution margin, and then subtract fixed cost, and that's my operating income. Okay? Just from another point of view of looking at the operating income. Okay. This should clear things up. So let's see. With the contribution margin, I said there is more calculations involved. But just look at it. It's not that difficult. So we said that our operating income is the sales revenue minus variable cost minus fixed cost. Okay? Very similar to it's the same as what we just talked about. Now we also had this. Sales price per unit, units sold, variable cost per unit, units sold, the same, right? Here's the difference. The difference between the sales price per unit and variable cost per unit is what we're going to call contribution margin per unit. So it's a difference, sales price and the variable cost per unit. That's my contribution margin per unit. Once I multiply it by units sold, I get the fixed cost and the operating income. All right? Now, let's look how do we find the formula itself. So to figure out how many units we need to sell to break even, I need fixed costs, I need my operating income, I sum those up, and I divide them by the contribution margin per unit. And my contribution margin per unit is the difference between the sales price per unit and the variable cost per unit. So just having this, the way to arrive to this equation is crazy, but once you have it, it's really easy to calculate. So So that's all you need for your contribution margin approach. Okay? All right. You got it? No? Okay.
Contribution contribution margin per unit is the same as contribution margin, like it's the sales revenue minus the variable cost. But you have to divide it by...
No, you don't have the units, right? When you say contribution margin per unit, it means per one unit. When you say contribution margin, it's your contribution margin per unit multiplied by units. Mm-hmm. So your contribution margin itself is a fixed cost and operating income. Okay? We'll call it that way. Okay, quiz time. Give me a second. Let me see how much there is left. Give me one more second, and then we'll stop. Shh, come on. Just one more minute. That's it. So just to finish this thought, we have, let's finish the contribution margin approach. So once we have this fixed cost of $12,000, and we know that the contribution margin is 120, right? We have the $80 variable cost, 200 is the sales price, right? So contribution margin per event is 120 is the difference. Now we know that our break sales in units is 100 events. Same thing, just faster calculation, right? Do you remember how we calculated it before? And we also found that you need to have at least 100 events registered, but it was much more complex, right? So let's check. We have our sales revenue, 20,000. We have variable cost. We know 80 by, right? It's 8,000. And now we know that the contribution margin is 120, right? The difference multiplied by 100 is 12,000. We have our fixed cost, and that's operating income is 0. So I need at least 100 events to break even, right? When I talk about break even, my operating income is always 0.